very respected speakers of this evening, CA Ramesh, the CA Sundarajan sir, moderator of this session, CA Subhashini Ganapathy, Secretary of SIRC, CA Panelist, senior members, friends, very good evening to all of you. Friends, it gives me immense satisfaction to once again join with you this evening for Bank Audit Interactive session. I hope this is the first time in the SIRC we have organized this kind of help desk for the benefit of members and students. On behalf of SIRC of ICAI, I welcome the great speakers of this evening, CA Ramesh sir and CA Sundarajan, and express my sincere thanks to them for accepting our request and share his wisdom amongst our elite professional gathering. I also welcome each one of the members who are all participating this evening session, and I deem it my present duty to offer my hearty thanks to the members who support by their active participation to our programs. Our speakers have spoken in many of the forums of SIRC and its branches on bank audit, which shows their love and affection towards SIRC and to the profession. In fact, Ramesh sir is the second round of address for this current year. Members, we have received so many queries from the members. It shows that most of the members already have started the bank audit. We are ready to answer all our queries. If anything is pending from our side, sure, we will answer tomorrow at the same time. Friends, today, in addition to our speakers, we have with us the very supportive person for the SIRC activities. She is having very good experience in direct and indirect taxation. She is the regular speaker, not only the branches of SIRC, she is also a speaker and the Minister of Skill Development, Tamil Nadu Government, and ICAI Academy. She is also the faculty member in training the income tax and the GST officers on various topics. She is a very good popular motivational speaker among the school and college students. With these few words, I am very much happy to welcome and introduce CA Subhashini Ganapathy as a moderator to this program. Before into the topic and interactive session, I request senior member of our regional council and the secretary of SIRC, CA Panelist, to introduce the speakers of this evening.
Good evening and thank you, Chairman. I take the privilege of introducing Ramesh and Sundarajan, both the speakers. First, I introduce Ramesh. He is a graduate in economics from various Vivekananda College, Chennai, and passed out information systems audit exams of ICAI in 2002, securing 10th rank, and he is employed as a peer reviewer, ICAI peer review board, and they presented on papers on accounting, auditing standards, bank audits, and various other topics at SIRC. And he has contributed articles to CA Journal and SIRC newsletter also. He has co-authored a book on bank audit, and is a faculty member of the training program of CAG office Chennai also. With this, I welcome once again Ramesh sir. Sir, thank you for accepting the invitation, sir. Now I will take 1 more minute to introduce briefly Sundarajan, sir. He's a fellow chartered accountant and having office at Hyderabad and Kochi. He's a qualified ISA auditor from ICAI, specializing in areas of accounting and audit practices, assurance, audit and assurance practices. He has been addressing almost all the branches of SIRC and ICAI on the topics of bank audit, audit and assurance standards, accounting standards, tax audit, corporate, and so many other topics. He has co-authored a book on bank branch audit released by CASC Chennai. He has been part of the ICAI various groups of professional interest on guidance notes, revision, etc. And he has co-opted on various committees of the SIRC and ICAI. And he has been a convener of CA study circle, and they have conducted many workshops, seminars, and etc. He has been actively involved in lionism also. He is still a lion. Once a lion forever. With this brief introduction, I welcome both of you, sir, and very happy to be part of this program. Over to Subhashini now.
Thank you, sir. Thank you, Chairman and Secretary, for the wonderful start of this program. Bank audit, as we all know, is a kind of very special assignment which we do, a one-time activity, but a very, very important activity which we do even if we take all the assignments through the year. This gives us more responsibility, more satisfaction, and this time it is a kind of, probably a warning type of a thing where we have to be all the more vigilant, more so because of the RBI circulars in light of the COVID, giving effect to the restructuring and the changed LFAR. So the lots of sessions have gone and all of us have attended sessions, but still the questions are keep coming, or I should say like they are flowing. I mean, we have about like 200, 300 questions which are unanswered. So today what we have done is our best attempt to answer all the questions, because definitely like the purpose of the session is to clarify even the simplest doubt people have. So we have consolidated the queries. So kindly request you all to pay attention to the explanation given by the speakers, because whatever explanations they give, they will just not answer the queries. Instead, they will definitely touch upon the related circulars and provisions from the theoretical and the practical point of view from their own experiences. So request you to pay attention so that your question may not be taken up as a question separately, but it will definitely be answered, is the assurance from our end. So first question, like I think the bank audit though ends with the LFAR, it starts with the LFAR as well. So I would like to start the question with Sundarajan sir. Sir, this time like after the change in the LFAR which is brought in, the basic question people have is that the 5% advance or the 10 crores, whichever is less, is one part of it, and the large advances. So what constitutes large advances, and should we really report all the sampling, whatever we take? How do we pick up the sampling, and where do I report what sample I took and what base did I take? So can you just throw light on all these aspects?
Yeah. Good evening to all listening to this session. I thank SIRC for this opportunity for sharing a little thoughts from my side on this bank audit seminar. It's a very, very light question which Subhash put actually. This large advances classification, earlier it was 5% or 2 crores, whichever is less. That was earlier situation. This year they have made an amendment to include 10% of the advances, and one more rider is 10% of the total advances, which includes fund-based and non-fund-based advances. Earlier it was not the case. So 10% of the total advances, which is including fund-based and non-fund-based advances put together, or 10 crores, whichever is less. So effectively, this is considered as a large advance. People are getting confused between what is large advance and what is the advances which you have to comment upon. First of all, we will have to decide as far as a branch is concerned. We have to divide it into two categories: large advances and other advances. There is nothing called small advances. Large advances, other advances. So large advances are advances which are having 10% of the total advances, including fund-based and non-fund-based put together. For example, if the branch has 50 crores of fund-based advances and 40 crores of non-fund-based advances, you will have to take the 90 crores as a value, and 10% of the advances is 9 crores. 9 crores or 10 crores, whichever is less. Obviously, for this branch, 9 crore will be the target for large advances. But once you decide what is the large advance, you have to go to the fund-based limits only. See, the 9 crores of fund-based limits, if it is available, it will be considered to be reported for the large advances. If there are no borrower who is having a limit beyond 9 crores, it need not be coming for large advances at all. So, well, first of all, we will have to identify what is the large advance on the basis of both fund-based and non-fund-based both put together, out of which 10% has to be considered, or 10 crores, whichever is lesser. And once you determine that amount has to be applied for the purpose of fund-based advances, and on that basis only we have to decide whether it is a large advance or other advance. Once it's identified as a large advance, all the large advances have to be examined. All the large advances has to be examined by us as branch auditor, and we are supposed to report. All the large advances means if there is going to be 20 advances, all the 20 advances has to be verified. There is no option for sampling in that. We have to see all the advances. What is that you have to see in respect of all the advances? Previously, there was no condition stipulation, etc. Now, RBI has made it very clear in respect of large advances. The entire large advance has to be verified with the orientation towards transaction audit, which means any borrower who has a limit of 10 crores and above or 10% of the advance, as the case may be, in his account, there are transactions which is happening by way of debits and credits. Normal course, we might not have gone into the transaction audit literally as far as branch audit is concerned. We will be going through the documentation, we will be going the overall allowance, overall disbursement, overall review by way of whether all the disbursements are done according to the requirement. To that extent, we will leave it like that. Now, what has happened is we are expected to go through the transaction audit. What do you mean by transaction audit is $1 million question once again. In my humble opinion, transaction audit means what all the transactions made in respect of that particular borrower's account, let it be a CC account or a term loan account as the case may be, both debits and credits are supposed to be verified on an overall manner. Next question immediately will be whether we have to verify all the transactions. It is not that verify all the transactions. By and large, you can go through these statements. Wherever you find huge transactions are there by way of a debit, those debits has to be examined. The reason is whether the end use is properly done. That is the first point. Whenever a loan sanction is being given, whether the end use is correctly monitored, for which the debits have to happen. Same way credits. What are all the credits which is coming? Whether the credits are relevant to the particular borrower's business activity. Because the business activity is something and money is coming from a different source, that is not good for the bank for its operations. So the transaction, both debits and credits has to be verified for the genuinity, relatability of that particular business activity, and whether it is entire operations, entire turnover is being brought into this account. This is this transaction audit. Where it has to be reported. The first point itself, they are saying that large advances you have to verify, and we have to list out what are the advances which we are verifying. There is a second question in this section. So question number 5 of advances itself, second question itself is like this. What they are asking us to report what are the accounts which has been verified, and they are also asking for a statistics. For example, if I have verified 13 accounts, all the 13 accounts has to be listed out with the balance outstanding and also with the total balance outstanding. What is the percentage which is being verified, that we have to report it there. Previously, this statistics was not there. So effectively, we were noting down in our records saying that these are all the accounts verified. Now they are asking us to commit what are all the accounts which has been verified. So on that basis, we will have to verify all large advances, and we have to report the now a list of advances which has been verified along with the balance outstanding, and what is the percentage of the total advances. That computation also has to be given. This is one side of it. Apart from this reporting, what is that to be reported as far as large advances? Whatever we have been reporting earlier by way of sanctioning, credit appraisal, monitoring, all these things has to be reported in respect of all the large advances, apart from the transaction audit which just now I completed. So as far as large advances is concerned, you are supposed to verify in an overall manner whether all the loans sanctioned during the year or renewed during the year, and even in respect of loan sanctioned in the earlier years, if it is part of the large advance, we are supposed to verify the entire transactions of this current year in a detailed manner. We are supposed to report any deviation. The one important thing which I would like to mention here itself is, normally we only report a deviation in respect of non-performing advances and other advances. Here, there is one specific question in long form audit report where they have said that top 5 standard advances you have to report. Normally, in case of standard advances, we might not have any reporting requirement at all. But top 5 standard, that's a different question. After this question, it will be coming. Top 5 standard advances also we are supposed to verify whether any irregularity is there, and the irregularity has to be reported. Will there be irregularity in standard advances? Definitely it will be there. At least small irregularities will be there. That has to be reported. If it is not there, we are bound to comment. There are no large advances. We have verified the top 5 advances. We have to list out that and say that there are no irregularities to be reported. So you are committing and asserting yourself to a clear situation that you have verified all these accounts. This is by and large about these large advances. Whatever be the other items other than these advances will come under other advances. So as far as other advances is concerned, we are supposed to verify whether the process of advances has been properly done. We are not required to verify this transaction audit literally, but we are supposed to verify the transaction audit also. But we are supposed to verify and report whether the process of loans disbursement, verification, etc. has been properly followed in respect of the advances examined by other, in case of other advances. We are not supposed to verify 100% of the other advances. We are supposed to verify sample of other advances, but at the same time, the sample should be able to cover at least 50 to 60% of the advances, even though it is not mentioned anywhere. This is by and large the sampling methodology. We have to verify at least 50 to, normally 30 to 35% of the advance will be covered by large advance itself. Balance on the 25% advances has to be verified. One more word of caution, we are supposed to verify all the types of advances, that is loan on deposit, staff loans, agricultural loans, jewel loans, all the loans we have to verify. Normally what we do is, we don't verify advances by way of loan against NSEs, loan against KVPs, etc. We don't verify, but we are supposed to verify those advances also, because we are supposed to report the process in respect of other advances. To this extent, if you understand and we do this larger and smaller advances classify properly and give the report in the LFAR, I am sure that we'll be able to cover what is required of us to duly, diligently deliver our professional requirement.
Thank you, sir. So I think this was a mini session on LFAR. Lots of questions are around this, picking up the sampling and what is large advances, what do we do with the other advances, what is process which we have to certify with the LFAR. Thank you, sir. That was a very detailed one. And well, the next question is to Ramesh, sir, in terms of the IRAC norms. Again, it is a very big questions, lots of questions comprised into one. Is the 20% emergency lending a kind of restructuring? And FITL loans, will it tantamount to restructuring? And obviously, like, you will have to explain what is restructuring, and whatever interest which is not paid during the moratorium period which is given by the RBI from March to August, if it is not paid before March 2021, will that be a NPA? So can you throw light on all these questions? I think this will answer almost like many of the questions which people have asked. So you're not audible, sir?
So you're not audible.
Audible. I think you're audible.
Yeah,
Yes,
now
Thank you, Subhashini. You have not given me just one question, you've given me a plethora of questions. But let me try and see how best I can answer those questions. You spoke about restructuring, and I think there's a lot of confusion in the minds of most of our members and the bankers more so, that the refacement or reschedulement of a loan does not amount to restructuring.
Exactly.
Let me tell you what RBI says about restructuring. It says any change in the terms and conditions of a loan, especially in the number of installments or installment amount or rate of interest, any of these changes will amount to restructuring. And just because the holiday period has been extended from 6 months to 9 months, bankers will say it's reschedulement, but it's all humbug. It will amount to restructuring. Or if the term loan repayment of 4 years has been made 5 years, and they said they only rescheduled it, not restructured it, again they are wrong. It will amount to restructuring. Any time the tenor is increased or the amount or EMI amount is reduced, which means the tenor is again increased, or the rate of interest, there is a change in the rate of interest, which is given to one single borrower and not across the board, will amount to restructuring. Now, with that definition in mind, let us look at what has happened because of this COVID-19 package, regulatory package, and the resolution of stressed assets due to COVID. In both these things, lots of concessions have been given, but they have not been given to one borrower, and they have been given to a plethora of borrowers right across the spectrum of the borrowers. And to that extent, they will not amount to restructuring. But if there's something, if some account of the restructure outside these circulars, outside the COVID circulars, for example, let us take a case of an MSME, where concessions are given to an MSME, provided they fulfill certain conditions. For example, they should not have a aggregate exposure of more than 25 crores, fund-based and non-fund-based put together as on a particular date. If on that date they do have, and they have been restructured before the COVID regulatory package came in, on the normal restructuring process, then they will be outside the ambit of this, and therefore that is a restructuring which has to be downgraded. Because RBI clearly says that once an account is restructured, the account must be downgraded. That is the normal rule. But because of the pandemic, RBI themselves have come out with a COVID regulatory package wherein they have deferred term loan installments, given a moratorium of 6 months for term loan installments, deferred the working capital facility for a period of 6 months, and therefore anything coming out of that will not amount to restructure. Now, FITL. You spoke about FITL. FITL is nothing but the interest from the period 1st of March 2020 to 31st of August 2020. The interest that has not been served or not been serviced have to be culled out from the working capital limit and converted into funded interest term loan. Now, the circular says this funded interest term loan must be cleared out before 31st of March 2021. The question is, what happened if it was not cleared out 31st March 2021? When the FITL was culled out and it was given to them as a FITL, there would have been a sanction letters stating the repayment schedule. The banks could have just said the entire amount should be cleared before 31st March 2021. Interest is to be serviced as and when debited to the FITL account. This could be one condition. Some of the other banks could have said you will repay X amount every month starting from October or September, and the final installment will be so much. Interest to be debited, interest to be serviced as and when it is debited. So any kind of sanction term could have been given to the bank depending upon the negotiation between the borrower and the bank. But finally, the FITL should be closed out before 31st March. But depending on the sanction, we have to take a call on whether the account is an NPA or not. Let us take the first example, where if there is only one line which says it should be closed out before 31st of March 2021, interest should be serviced. If the interest has been serviced all the months till December or January or February, then the account has not been closed out. They have 90 days from 31st of March before it becomes an NPA. Because interest has been serviced till December or January or February, the account will continue to be performing as of 31st March 2021. In fact, if they have paid even December interest and they have not paid January and February, according to the normal IRAC norms, it will be a performing asset. And as far as the principal amount is concerned, they still have another 90 days from the date of 31st March 2021. However, if the interest has not been paid at all, and both the interest and the principal outstanding, then the account will become a non-performing because they have not serviced the interest, and the October interest has been overdue for more than 90 days, and therefore the account will become an NPA. So we'll have to go by the terms and conditions of sanction. Supposing there had been a case where they have given a bullet payment, let's say the FITL amount itself is 10 lakhs, and they have said October, November, December, January, and February, you will pay 5 lakhs rupees each month, and along with the interest debited during the month, and the borrower has not paid it, or has paid only October and November, has not paid December, January, and February, then the account will become an NPA because December installment is due for more than 90 days, and therefore the account will become an NPA. Again, in that case also, the interest and principal is something we need. See, here we apply the normal rules of term loan accounting for the purpose of finding out whether an account is an NPA or not. The moratorium on interest given by the COVID regulatory package has nothing to do with this. That is a different moratorium. There, the interest need not have been serviced, and that is the amount that should come into a FITL, not the earlier unserviced income, unserviced interest. If there had been unserviced interest even before the COVID, before 1st March, then that should be seen when it has been cleared out. For example, if interest of January and February had not been cleared in the term loan account, then from March to August, they cannot obviously insist on interest repayment. But that interest should be cleared out in September. If that doesn't get cleared out even in September and goes on to October, then January installment is due for more than 3 months. January, February, again September, October it will become an NPA because it is due for more than 90 days. So this is something which we need to very clearly understand. Normal IRAC norms will apply. However, the 6 months will not be counted for the purpose of calculating delinquency dates. So if an account is overdue by about 30 days as on 28th February, and there is a moratorium given, forget for a minute that he even goes into restructuring, and a moratorium is given, then from 1st of September, another 60 days if the account is out of order without it coming to normal, then the account will become an NPA. So we must be very clear on our minds that this moratorium given is only for the purpose of interest payment and principal payment for that 6 months. In the case of term loans, the 6 months essentially means that the tenure of the term loan will increase by another 6 months. For example, if the term loan ends on, let us say, June 2024 as per the normal original sanction, because of the 6 months, it will end only in December 2024. That is the effect of it, nothing else. If we are able to distinguish between the COVID regulatory package and the normal IRAC loans, I don't think we'll have a confusion at all as to how to deal with the COVID cases. Subhashini, you want any further questions that I missed out? Because you read a lot of questions, so if I missed out something, please let me know.
Sure, sir. When questions keep coming on the same lines, definitely we will take it up. And, next question probably to Sundarajan, sir. how do we look at the accounts where there are no credits or low credits, where the stock statements are not received, and one loan closed with the fund received from another loan, more so in the case of staff or otherwise gold loans per se. I mean, can you just cover all these aspects, sir?
Once again, you have pumped in 4 questions into this. Let me go one by one. One is few credits in an account. Few credits in an account or very rare credits in its account. See, basically, RBI has categorically said that an account can be considered as technically as an NPA, even though all the interest is being recovered, all the installment up to date has been recovered. But for the whole year, if there are only few credits available or solitary credit is available, you can still classify the account as an NPA. So that liberty they have given to the auditors. So auditors has to subjectively examine an account whether any collections has been made, just like that. That is for the whole year, no money will come. On 27th of March 2021, they would have come and pumped in 1.5 lakhs just to cover the entire interest just of that. In that situation, you are eligible to classify that account as an NPA on the basis of solitary or few credit. This is one side of it. So effectively, it's one of the technical NPAs. Second item which we are referring is in respect of one loan is given and are taken to another loans. See, there is nothing wrong in giving one loan to settle the other loan. That is, there is nothing wrong, provided the other loan was also operating regularly as standard. Once an account becomes tentatively substandard and a loan is given only for the purpose of clearing this loan, then this account has to be classified as an NPA. I'll just take an example out of this. A person is having a CC account of 10 lakhs. He is having a term loan of 25 lakhs, wherein he has a monthly payment of 50,000 rupees is being paid. Suddenly, he has accumulated 2 installments and the third installment is going to come shortly. Say, for example, 1.245 lakhs is the outstanding. Once it is go beyond 1.5 lakhs, it becomes an NPA, which means it is SMA 02. In that situation, they give a CC limit enhancement to the extent of 2 lakhs. Without any other requirement, suddenly they are giving an CC enhancement of 2 lakhs and this 2 lakhs is being adjusted towards a term loan. Without any other specific requirement, this is only done for this limited purpose, then you can have a very, very valid category for classifying this account as an NPA. But in the normal course, instead of 10 lakh CC account, where there has been a continuous assessment of the working capital requirement and now it is increased to 15 lakhs. And from that 15 lakhs, this amount is adjusted towards term loan. As long as the term loan has not slipped into NPA, at that time this loan is given and it is taken to the term loan account, there is no problem. So once again, auditor has to subjectively verify these 2 transactions in a proper manner, whether the intention of disbursing the loan itself is only for adjusting the other loan or not. This has to be verified in a detailed manner. If that adjustment is not there, even otherwise the loan would have been, a proper process would have been there already, and in that situation a sanction is being given, you don't have to bother. This is the second question which you have asked. Third is in respect of jewel loans. Jewel loans, once again, they are to be classified into 2 categories. One is agri-based loans and another is non-agri-based loans. Non-agri-based loans has to be given only for a period of 1 year. That is the maximum limit available as far as RBI is concerned. Agricultural loans can be given for a period of 2 years. So from the date of sanction, within 1 year, non-agri loans has to be closed. If it is not paid within 3 months from the end of the 1 year, it will automatically become NPA as far as non-agri jewel loans are concerned. Jewel loans are not exempt from NPA classification. Let us be very, very clear. As far as jewel loans is concerned, it is given for a period of 1 year. Basically, it's a demand loan. And if it is not settled within 3 months from the end of the 1 year, it will become a non-performing asset. Here, one question normally comes is, what will you do in case of a jewel loan which is completed in 1 year, and on that day they will come and pay the interest and the loan is being renewed once again? There is no concept of renewal in case of a jewel loan. Jewel loan has to be fully closed and a fresh loan has to be given. How this has to be examined by the auditors? It is for the respective auditor to go through the transaction and satisfy themselves that the loan has been fully settled and it has been repaid. Same analogy will be applicable in respect of agricultural loans also, only with a small rider, that it is first thing is it is for a period of 2 years. It can go up to 2 years period, and after that also it will become an NPA if it is a short-term duration crop for 2 crop seasons, and long-term duration crop means it is 1 crop season, 1 additional crop season, which means effectively by thumb rule we can say After 2 years, another 1 year can go for short-term durations or long-term duration as the case may be. Because long-term duration crops is normally 1 year or 18 months as the case may be. Short-term duration crops is anywhere between 4 to 6 months. So 2 short-term duration crops means another 1 year can go. So up to that, it can continue to be a performing asset. After that, it will become a non-performing asset. This is as far as agricultural jewel loan is concerned. Once again, in the agricultural jewel loans also, same concept of giving one loan, settling the interest alone and renewing is not acceptable. That loan has to be fully closed and a fresh loan has to be given. Then only that will be considered as a fresh loan, which is eligible for another 2 years of term according to which it has been. Anything I have missed out, Subha?
Perfect, sir. I think you've covered everything. So extending the same question to Ramesh, sir. Can you just throw light on the early warning signal, the SMA 0, 1, 2, and the NPA, the potential NPA, and out of order, of course.
Just to add to what Sundar said about the gold loans, essentially the entire principal and the interest as on that date should be closed out and a fresh loan can be given on the same day. There's nothing wrong. Now, how do you verify that? You can take a look at the cash scroll to find out whether the principal has actually come in terms of cash. We did do that in the case of in the case of a branch where they said the entire money was repaid and we have only opened a new account, but then we found that money had not come in at all. Only the interest portion had come in, which is very easily verifiable if you look at the cash scroll and to see whether the amount had come in. Of course, they can be clever in that also. They can show either because it's the same amount going out, but then how many of them will do that is a question. So you can take a look at the cash scroll to find out how it is done. Whether genuinely the farmer has come and paid or whoever the borrower has come and paid the entire amount in cash and has again taken a fresh loan. Coming back to the question that was supposed to be by Subha. Subha, for a minute I forgot the questions. My slipped out of my mind. Can you repeat the questions again?
Yes, sir. So just on the early warning signal, because that's a kind of fancy word which is common now. The early warning signal, the SMA 0, 1, 2, and the out of order account and the technical NPA. So just covering all the loans so that like people are clear in their minds as to where to put this particular account.
The early warning signal is something which the Reserve Bank of India spoke about in their circular framework for fraud, which was issued as early as 2015. They said the early warning signals should be noticed by the bank and those accounts should be red flagged to ensure that the proper monitoring and if necessary even a forensic audit is conducted of those accounts to ensure that those accounts do not become a fraud account. Which means the minute you find early warning signals, and they've given about 45 items in the annexure to that circular, which are all indicative, it's not an exhaustive list, they say it's indicative of a fraud in the account. And these they say are early warning signals. As auditors, if we are able to have that 45 items by our side when we do the audit and find that there are accounts which more than 4 or 5 early warning signals, then to that extent, I think we should definitely mention about it in the long-form audit report, as these are accounts with more than 4 or 5 early warning signals as per the RBI circular, and therefore we don't even have to say that they are potential frauds. We have to only state that these need close monitoring, and if the account is large, you can even recommend a forensic audit. This again will depend from case to case. You need to look at the operation of the account, look at the EWS signals, and if you think that there are certain things in the financial statements which do not give you the confidence that the borrower is on the right track, then you can even suggest either a stock audit or a forensic audit to ensure that everything in the account is all right. EWS is not something by itself, is not something which is to be viewed in isolation. It is something to be viewed as and when you are looking at the statement, the accounts of the borrower. Sundar was referring to the transaction audit. I think that is a very key thing, especially in the case of large advances. You are going through the account, through the transaction, and you find that there are a couple of checks that have been issued by them which get bounced, or checks deposited into their account to bring it to the NPA which are getting bounced. Those are again early warnings. Or if on the same day every month, a particular amount, which is not even a round sum amount, let us say 5,22,840, something like that has been comes in as a debit every month on the same day of every month, then you are again put on suspicion or not. Is it something that he is paying an EMI to some other bank or some other financial institution that he has borrowed? It could be from a market loan. Those are all early warning signals. In fact, the RBI says non-payment of statutory dues is the early warning signal. So if you're looking through the corporate account and you're looking through the audited financials and you find in Caro that a huge amount of tax has not been paid, which is due but not paid, and the auditor qualified it in Caro, then that itself is again another early warning signal. So these are things that you need to look at. Lots of early warning signals have been given. 45 cases, which are all very simple ones, which we cannot miss out at all. These early warning signals, there are, in my opinion, maybe one early warning signal might not, set up my antenna. But if I find a pair of them, or 3 or 4 early warning signals, or 45 that has been given there, then if I was doing the audit, would certainly highlight this account in my long-term audit. Even though it might not be top 5 accounts or the top 20 accounts of branch, it might be still an account of a size that is of concern. I will certainly write a note about it in my long-term audit report, saying that this is an account which needs to be monitored very, very closely, because it might slip into NPA and it could turn into a fraud account. This is something which we need to be very clear. So coming to out of order account. An out of order account is one which is applicable, this term out of order is applicable to a working capital facility. The IRAC norm says an out of order account is one which the account which is operating far in excess of the sanction limits or DP, whichever is lower. To take a simple example, let us assume that this working capital facility CC account that has been granted is 1 crore. The minute it operates at a balance more than 1 crore, it is out of order. And let us assume that the drawing for 1 crore 25 lakhs, sanction limit is 1 crore, therefore they are allowed to draw up to 1 crore because that is lower of the two. The minute it starts operating at 1 crore 5 lakhs or 1 crore 10 lakhs, then the account becomes out of order. Invariably, you will find even in a very well operated account, standard account, this thing happening for a day or two. It is an account where the balance as on, let us say, the last day of the month or the day on which the interest is debited is about 99 lakhs 50,000. An interest of about 70 lakhs is debited, 70,000 is debited, and it becomes 1 crore 20 lakhs or 20,000. Then it is out of order. But 3 days later, funds come into the account and it comes back to less than 10 crores, then the out of order goes away. The question is, when does the out of order go away? If the out of order situation continues for a period of 90 days, then on the 91st day, the account becomes a non-performing asset. Again, let us be clear that on the 94th day, funds which were due to the borrower, genuine funds which are due to the borrower, but which did not come because his customers did not pay him, suddenly comes in. Or a bill discounted which is pending, or an LC which is pending, somewhere or the other, the money does come into the account. From genuine sources, the account will again become a performing asset. As far as CC account is concerned, the balance is dynamic. On a daily basis, the balance keeps changing. It can be NPA yesterday and it can become a performing asset today. But if it becomes out of order yesterday, it cannot become an NPA today because it has to be out of order for a period of 90 days. Only on the 91st day can the account become an NPA. And on the 94th day, the account can again become a performing asset and become out of order on the 95th day. So it's a very dynamic situation. We need to understand when it becomes out of order. It becomes out of order when the balance of the account is in excess of the sanction limit or drawing power, whichever is lower. I think I covered EWS, I covered. Now coming to SMA. SMA classification, nothing but a classification of the accounts. It's a classification of standard accounts. Standard accounts are classified into 3 formats: SMA 0, SMA 1, and SMA 2. This was first brought out in the circular that dealt with resolution of assets. See, we had lots of schemes for resolution of assets. They did away with all that. And in 2018, if I remember right, they came out with the framework for resolution of stressed assets. In that circular itself was applicable for borrowers in excess of 2,000 crores to start with. And then they were supposed to come out with other loans. But because of COVID, that itself got extended. But in that circular, RBI has talked about SMA accounts. They have said an account which has a due for more than 1 day. See, if there are no dues at all, the account is standard. The minute there is a due for more than 1 day, it becomes an overdue account. And if the overdue is between 1 day to 30 days, it will be a SMA 0, classified as SMA 0. The risk is low. Yes, the risk here is more than the risk of a standard asset, which has no dues at all, but the risk is low. The minute it crosses 31 days, 30 days, from 31st day to the 60th day, it will be classified as SMA 1. The risk is moderate. And then it goes to the third category, SMA 2, which is 61 to 90 days. the risk is very high because it's only a matter of days before it is into NPA. If I was doing the audit of a bank, the first thing that I probably will ask, one of the first things that I'll ask when I sit in front of the bank manager is, give me a list of your SMA 0, 1 and 2 accounts for January and February of 2021. Because an account which is an SMA 2 in January could have probably come to SMA 1. But will it go to SMA 0 or will it go to not even SMA 0 by 31st March is a moot question. That is something which I would like to take a look at. And if it is SMA 2 in February or in January, has it gone to NPA or if it has been regularized, how has it been regularized? Has it been regularized with genuine sources like what the Sundar was talking about, or has it been regularized by granting an additional loan, not necessarily in the same branch, but in another branch, and those funds are coming to this account to make it regular? That is something which I have to take a look at. Also, let us remember that there are certain times when the banks says, sir, he has paid the arrears which are due for more, and therefore the arrears have come down to less than 90 days, and therefore we have classified it as performing. I think we need to spend a little time here also. Once an account is classified as NPA, if it has to be upgraded to performing, all the amount due as on that date must be cleared out. To take an example, an account is classified as NPA in let us say November for non-payment of term loan for 3 months. In January or February or even in March, they come in and they've cleared all the installments up to December and also clears all the interest due up to December. Therefore, the bank says it is no longer non-performing. It is performing because they have cleared all the principal installments and the interest that was debited till December, and therefore we have upgraded. That is the wrong concept. RBI says if he is clearing on 28th of March, he should clear all the dues till 28th March, and only then can you upgrade. Otherwise, yes, you can accept the money, credit the money to the account, but it will continue to be NPA. Is there any question I missed out?
Nothing's up perfect. So I think that was you covered everything. Sundarajan, would you like to add something on this?
Yeah. Apart from this RBI guideline, Institute itself has brought out in this guidance note saying that whenever an account is becoming an NPA, the entire arrears has to be cleared. There is an RBI guidance note is also there, which ICAI guidance note is also there, wherein once an account becomes an NPA, the entire arrears has to be recovered. Not only from RBI, our Institute guidance note is also there. So we have to ensure that the entire arrears has to be recovered, particularly in case of term loan. As Ramesh rightly told, working capital loan, there is no problem. It keeps on oscillating between out of order and performing and non-performing. But in case of term loan, once it becomes a non-performing, the entire arrears has to be cleared. Then it becomes a performing asset, and subsequently it can once again become a non-performing asset.
Perfect, sir. So thanks. And the question to Sundarajan sir on LFAR, you did cover this point in your when I asked you the first long question, but still I think it is worth repeating. Lot of questions around LFAR. So people say like there are LFAR questionnaire actually comprises of lot of questions right from sanction, monitoring, valuation, security, provisioning, everything. So if I'm going to pick up, I mean the 10% of the 10 crore is one benchmark which I take and I select a few advances. So is it okay if I do a few sample pertaining to credit monitoring, few pertaining to sanctioning, or should I do a complete check of answers? Should I find answers for all the questions in LFAR for the large advances which is prescribed?
It's absolutely clear. As far as large advances is concerned, we are supposed to verify all the parameters, right from the credit appraisal, sanctioning, disbursement, documentation, and until the monitoring and supervision. The entire gamut of the advances, right from the credit appraisal till the monitoring and supervision, has to be fully verified as far as large advances is concerned, apart from the transaction audit. So as far as large advances is concerned, you don't have an option to say that for this one large advance I will see only credit monitoring, one large advance I see documentation. Not acceptable. Once you identify the large advances to the extent of say 7 or 8 accounts in a particular branch, on the 7 or 8 accounts, you are supposed to verify the entire gamut of operations. What will happen is in case of large advances, which is in the bucket of a term loan. So in that cases, current year there may not be any transaction other than the repayment. In case of a working capital, there would have been a renewal. Once again, all the set of documents has to be seen. Let us see both the examples. a working capital loan which is coming under large advances. Once a working capital loan comes under large advances, every year it has to be renewed. So once a renewal happens during the period under audit, which is 2020-21, at the time of renewal, the credit appraisal should have been done properly by obtaining the audited financial statements. Please note that members have to understand, till last year, at the time of renewal, even a provisional financial statements are allowed. But in the current year, it is categorically said, when a renewal or review is being done, it has to be done only on the basis of the audited financial statements, latest audited financial statements. So that is part of the credit appraisal. So whenever a working capital loan, which is in the process of renewal during the current year, we are supposed to verify the credit appraisal. And wherever there is a limit which is increased, obviously security charges which has to be created for the enhanced value, or there is a modification by way of interest rate, etc., that also has to be structured. And documentation additionally, if it is required, has to be brought in. If there is additional capital which has to be brought in, that has to be brought in. Documentation has to be done by way of execution of specific documents by way of mortgage, etc. This, apart from that, the disbursement has to happen according to the stipulations. In case of working capital loan, normally there will not be any problem. It will be going on like this. But once again, this should not be going to adjust to the term loan which is outstanding otherwise. So similar thing can happen. So this is in respect of a working capital loan which is being renewed by way of large advance. So it starts from the credit appraisal, monitoring, sanctioning, disbursement, and also finally supervision. What is supervision? Once again, whatever they have given by way of a CMA data at the time of earlier renewal, whether what is given in the CMA data, whether they have achieved. For example, in 2019-20, when they have taken a limit of 10 crores, for which they have given a turnover of around 30 crores. 30 crores will be the expected turnover for which you give a loan of 10 crores. We have also given. And we means the branch has already given 10 crores. We have to ask for the financial statements of 19-20, whether they were able to achieve the 30 crores turnover. That 30 crores turnover is not achieved. They have achieved 28.65 crores. There is no problem. But if they have achieved only 20 crores, which means that limit which has been given for achieving the turnover of 30 crores has not been properly monitored. This is one side of monitoring. The other side of monitoring is whether the stock statement which is being given on a month-on-month basis is reasonable, right, and fair. That has to be examined. Apart from this, with the stock should have been verified by our branch officials also, whether they have periodically gone and verified the securities which has been done. That also has to be reported. Apart from that, the stock or goods which has been hypothecated should have been covered by insurance, whether the insurance is live. That also has to be verified. And apart from that, whether the turnover which is being shown in the financial statements, audited, provisional statements for the current year, and the CMA data is routed through the account. What do you mean by routed through the account? The turnover of that particular business should be routed through this particular bank account. If it is not routed through this particular bank account where the CC limit has been given, there is a very potential danger of an early warning signal wherein the money is being circulated outside the particular banking system. In that situation, this account can become an NPA at some point of time. This is in respect of large advances. We are supposed to verify the entire gamut in respect of working capital, right from credit appraisal. Because why I'm mentioning this specifically is members always get confused that it is a last year advance, I don't have to verify this year. It is not the case in case of working capital. In case of term loans, which is coming under the large advances, probably you might not be going through a credit appraisal unless otherwise he also has a working capital limit. If he has a working capital limit, when the renewal happens, the term loan also will be renewed or reviewed as the case may be. But if they have only a term loan situation, in that way we have to necessarily see whether the credits by way of recoveries are coming properly, whether the party is having a current account with us wherein the turnover is being properly, regularly monitored. The next item is in their current account, whether unusual debits are coming by way of what Ramesh was telling, some ad hoc figure of 5,22,220, which is coming irregularly, maybe an EMI of some other loan which has been taken without our permission. Because all said and done, banks take a condition with the borrowers that once the loan is taken, they are not supposed to take any loan from any other financial institution without the prior approval of this particular branch. If it is done, monitoring is having a gap. So once again, monitoring will be there in respect of term loans, whereas in case of working capital loan by way of large advances, right from credit supervision, credit appraisal till the monitoring and supervision, entire thing will come as far as large. All the accounts Once again, there is nothing like sampling. As far as large advance is concerned, if you have picked up 10 large advances, all the 10 large advances, you are supposed to verify the entire documentation, entire credit appraisal, and entire monitoring.
Thank you, sir. So once the sample is picked, it has to go through and answer all the questions given in LFAR. So there is no choice.
Once again, it is not sample. As far as large advance is concerned, it is not sample. It is a stipulated condition. We will have to be very, very clear. As far as large advance is concerned, we are not given an option. They have categorically said their percentages and parameters. Within that, we don't pick up the sample. We pick the large advances. In respect of large advances, we are supposed to, in fact, it is good for us because if you cover 10 large advances, maybe we will be covering 35% of the total sample, which itself is good for our auditing essay on auditing of sampling also.
Perfect, sir. Thank you. So extending the same question to Ramesh sir, Sundarajan sir was talking about the working capital loans. So Sundarajan sir was mentioning like it is not the loan sanctioned in the previous year, so we cannot just brush away that this particular working capital loan was sanctioned in the previous year. We will have to monitor, and we are still responsible to report the monitoring or the performance and the deviation, including the stock statements, etc. So can you throw some light on the short review and the ad hoc sanctions and its effect on the classification and the provisioning as such?
The bankers normally have this habit of telling that this account has been short reviewed, and therefore you should not classify it as an NPA. And unfortunately, quite a few of our members believe that a short review is sufficient. I don't think a short review is sufficient. Yes, it is sufficient as long as 180 days has not passed from the date of sanction expiry. If the sanction has expired on June 15th, then within 180 days from June 15, 2020, the account must be renewed. If it is not renewed, the account will become an NPA as per the IRAC norms. Now, in fact, in that reasoning, why RBI is giving 180 days, the reasoning in the circular of RBI very clearly state that we understand that corporate borrowers need time to give their audited financial statements. And to that extent, I think even during last year, audited financial statements were a must for doing a renewal. Although it was not very explicitly stated, it was must because the logic of giving 180 days, they very clearly explained the corporate borrowers need time to submit their audited financial statements and their CMA data and all other financial data, and therefore a time of 180 days was fixed. Beyond that, it should be classified as NPA. Within the date of expiry and 180 days, you can do any number of short reviews, medium reviews, long-term reviews, whatever the bank wants to do. Clearly, on the 181st day, if it has not been renewed, it should be classified as a non-performing asset. So again, the first thing that, again, one of the things that you should ask as an auditor when you go to the bank is, what are the accounts for which expiry, the sanction has expired before September 2020? If you can get that list, see what has happened to those accounts. Have they been renewed? If they have not been renewed, then they will tell you, yes, sir, we have sent the proposal to head office or regional office. They have not got back. It is the sanctioning authority who has to renew it, not the branch. It is not in the sufficient. The branch has sent it, and it does not come back. Maybe the one or two leeway that you can give them is if the sanction had taken place on the sometime in the last week of March, but was not communicated to the branch by the regional office, and then a letter comes from the regional office saying it has been done. Even in that case, I would probably suggest that you ask the regional office to fax across the sanction letter duly signed by the original sanctioning authority. It cannot be done by anybody else other than the original sanctioning authority. Or if it is the head office sanction, then it must be only renewed by the head office people. Or if it is by the board of directors, then it has to go to the board of directors for it to be. So if that is not available, I think you need to classify the account as a non-performing asset. In fact, most often than not, these are the cases that we tend to miss out because of the vociferous attitude of the bankers. They take a stand that this is not right. The previous auditor did not accepted our contention. You know IRAC norms much better than the banker will ever know. Please go ahead with your knowledge of IRAC norms and be confident of what you're saying. Do not yield to temptations or do not, I'm sorry, not the right word, and do not yield to pleadings from the branch manager and classify the account of the NPA. Coming to the other aspect of the technical NPS, you need to look at whether the account was has been reviewed or not. You also need to look at the solitary credit as rightly pointed out. If there are very few credits or very solitary credit, then you have every right to take it as a NPA. The third item is stock statement not available for a period of 2 months. Now, RBI says the drawing power computed on a stock statement which is more than 3 months old, the DP should be made 0. So, if that is the case, then let us say the stock statement of October is available. If October is available, November, December, and January, the stock statement, the DP is fixed as per the 30th October stock statement is available. After that, there is no stock statement available, then the DP becomes 0 on 1st of February. February, entire month of February and March, it is 0, and therefore it has been out of order for 60 days because any balance in the account will be more than the DP since the DP is 0, and it continues for another period of 1 month. In April, it will come in. He took the example of October stock statement. Assume stock statement of only September is available. Then the DP for October, November, and December can be fixed. As on 1st January, DP becomes 0, and since it is continuing for a period of 90 days, in the spirit of January, February, and March, it will have to be classified as NPA as of 31st of March 2021. What can happen is the minute you point this out, they could give you a stock statement signed by the borrower of February. Take a very close look at the stock statement. Does it really reflect the stock position that that could have traversed from September, last stock statement? From that stock statement, they show a lot of purchases, but there are no movements at all in the CC account. Creditors have not been paid. There is no movement in the account. Money has not been deposited. They just managing to keep it some 5% below the sanction limit or 5% more than the sanction limit. It's fluctuating between that. Very few transactions. I think these are all things that you can take as an auditor, go against the stand taken by the branch and classify the account of an NPA.
Yes. Thank you, sir. So on the extending the same question again on stock statements and DP, there were a few questions which threw concerns on the creditors, because whatever stock statements the bank collect, it will be stock statement and the data statement. So where do we pick the creditors numbers from? Because stocks are actually the paid stocks are the ones which has to be taken for the DP calculation. So the creditors numbers are missing, then how do we calculate? Will we not go wrong in computing the DP is one point. And what are the other precautions which we can take in terms of the inspection gone by the branch to the premises and taking inputs from there? Sundarajan sir, can you throw some light on this?
Yeah, this is a very, very vital and critical point as far as stock is concerned. Working capital advances are concerned. First of all, we will have to decide whether the stock statement which is being given month after month, does it have a unique item of repeated figures without any much thought process. They give a standard figure of 25 lakhs and they keep on giving a stock statement without much additions, etc. Let us be very, very clear. The stock statement, that each and every bank has its own format of having a stock statement. According to that, the stock statement has to be given. The next question is whether it is relating to the paid stock or unpaid stock. The point which has to be very, very clearly identified is RBI is making it substantially clear that there cannot be double financing. That is the intention of the Reserve Bank of India, which said that in sufficient words that working capital funding by the banker should not ensure double financing of the same product, which is a fact. But at the same time, each and every bank have their own system of determining the drawing power. When they determine the drawing power, they have a system of having X amount of working stock will be taken for the purpose of drawing power. Y percentage of book debts will be taken. Other assets are there that also will be taken for the purpose of determining their drawing power. On that basis, they will say, in that situation, if the original sanction ticket makes it very, very categorical that the creditors for goods will not be removed, I don't say that they will be definitely having that particular point. In case the sanction ticket makes it very, very categorical that only stock value has to be taken, book debts value has to be taken, other assets to be taken, percentage of figures are being, it is presumed that when they give 50% margin for the booklets or 60% margin for the purpose of stock, this unpaid, that is unpaid creditors component, is reasonably accounted to that extent. If that is not given, if the sanction ticket is very, very clear that creditors has to be removed, obviously the stock statement which they are mentioning has to have the creditors figures also. So once again, all these things goes back to the sanction ticket, which is very, very categorical regarding how the DP has to be computed. Another critical component which has to be addressed by all our members is RB is very, very categorical, saying that whenever a drawing power is determined on the basis of a particular CMA data, in the CMA data, what is the stock level available and what is the creditors available? Periodically, at any point of time, the same level of percentage has to be maintained. This is what Reserve Bank of India's expectation. For example, when a CMA data is given and they have put a stock statement, stock figure of 100 crores, and they have disclosed the creditors limit to the extent of 30 crores, and balance 70 crores is a paid stock for which they have given a application for 50 crores of limit, and it has been given. Anytime during this period of monitoring, this 100 crores of stock becomes 120 crores, and the stock also goes from 30 to 35 crores, no problem. But if the stock statement of 30 crores goes to 60 crores, and the stock statement retains at the same level of 100 crores, there is a problem. So this is what is expected as far as RBI's stipulation is concerned. Auditors are supposed to verify this also. That is second item. So one is regarding the quantum of stock which is being periodically mentioned. Number two, regarding the unpaid creditors. Third, whether there are non-moving stocks which is being disclosed in the financial, the stock statement which is being given. How is it to be determined? Definitely, when you are considering a stock statement on a continuous basis, at least in the respect of large advances, you will be able to see a design where from the same stock figures are being reported. They will also give a list of items which is available. Invariably understand that in case of certain particular segment of advances, there are certain products which are being produced for a specific segment of customer. If the customer has rejected the order, that particular stock will not be having any value at all. But as far as books is concerned, they will be having a specific amount of value. So this is very, very important, where you have to see whether there are non-moving stocks which are being there. If that is the case, that non-moving stocks has to be removed from the stock for the purpose of drawing power. When you come to the book debts, once again, normally any book debt beyond 6 months period will not be considered for the purpose of drawing power, with exceptions. What is the exception? For example, if it is an NHII loan, that is NHII has borrowed from one particular bank, all their projects are long-term projects. In those cases, the working capital cycle itself is more than 1 year. In those situations, book debts time can be done according to the working capital cycle, but sanction ticket has to mention that. In that situation, once again, the drawing power has to be calculated with a slightly modified methodology by determining in that particular drawing power computation. Leave alone all these things. From this year onwards, in long form audit report, auditor are supposed to give a comment saying that whether the drawing power has been computed properly or not. Till last year, it was not the case with a specific question. Till last year, we have been verifying whether the stock statement has been obtained periodically. Yes. If not, we just give a report. Now, in this current year, whether the drawing power has been correctly computed, it is question which is being asked. So like what Ramesh was telling, if the stock statement has not been received from the month of October, obviously you have to report that for the past 5 months stock statement is not obtained. It is monitoring is a problem. The other item is there is one more specific question wherein whether the drawing power has been computed properly. You have to categorically mention drawing power was not computed properly in the absence of necessary stock statement or booklet statement for the recent 5 months. This is very, very important. So the audit is not that easy. Number one, we'll have to be very, very clear. Second issue, as far as working capital advances is concerned, regarding the stock and booklet statement, we have to be very, very careful. And all in respect of larger advances, please check up whether the stock audit has been done. And when the stock audit is done, the stock auditor should have specifically mentioned whether any non-moving stocks are there or debtors in excess of the period of 3 months has to be there. And that has to be considered by the bank for removing the drawing power. Because once again, the stock statement, stock audit report, one additional point has been brought in, whether the stock audit wherever it is required, has it been done? If it is done, we have to report. If it is not done, we have to report. Second additional question, wherever there are negative comments, which is by way of stock auditors, whether the negative comments has been treated properly by the branch which has to be reported. So let's be very, very clear in respect of working capital advances, wherever hypothecation of stock or book debts is there, we have to necessarily go through the entire transactions in a proper manner, subjectively verify the respective stock statements. Apart from that, as Subha was rightly pointing out, whether the branch has been periodically inspecting these stock statements and whether they have recorded in the inspection register, and on the date of inspection, whether they have debited the inspection charges also. All these things has to be combined together, and then we will have to do the audit. All these things, at least for large advances. Let us be very, very clear. At least for large advances, we have to definitely do it.
That was precisely my next question. So this is obviously, like you clarified, this has to be done for all the large advances. Obviously, though large advances go through all the questions. But this, will it not tantamount to a process lapse? Is not monitored for the other advances. So are we not bound to disclose this for all the advances of the working capital advances? So
yeah, I will continue because it's a question related to the same question. The point is, in respect of other advances, the question, basic question itself, whether the process of advances verification, all the documentation is properly done in respect of other advances. So other advances, we choose the samples. We choose the samples by our own sampling methodology. We will pick up the samples. In those samples, we have to necessarily verify whether this a process of obtaining the stock statements is properly being done or not. In case it is not there, we have to report. See, let us be very, very clear. There may be senior members in this group. In the earlier occasion, there are only two questions. In respect of large advances, is there anything to be reported? In respect of other advances, is there anything to be reported? But people were not probably reporting properly. So they have expanded the entire question. One question has been divided into 25 questions. And all of us are in a problem. We have to categorically mention. So in that situation, in respect of other advances, we are necessarily supposed to verify whether the process has been properly done. If the process is not done, we give a report and leave it like that. And in case one particular unit, the process is not done, because of that, there is a drawing power cap which is there. In that situation, we have to report the drawing power, and also we have to classify the account as non-performing asset if it has gone out of order beyond 3 months, as Ramesh was mentioning.
perfect. Thank you. Ramesh, can you? Yes, sir.
Can I add something to what Sundar was talking about for the last couple of minutes?
Yes, sure.
This directive of RBI that unpaid stock should not be financed is not something new. This is given the directive way back in 1993. And year after year, we have this question from the members: what happened? What about unpaid stock? Unpaid stocks have to be reduced. Please go through paragraph 11.189 and 11.190 in the guidance note on audit of banks, ICAI guidance note. Supposing you come across stock statements where there are no figures of unpaid credit figures not available, then what do I do as an audit? Now, one of the things that I do in my audit when I do audit of banks, or when I was doing audit of banks, is to look at the stock statement given by the borrower in the month of April 2020 with regard to March 2020 stock figure position. And then I will also look at the financial statement that is submitted sometime in September or October after the tax audit or the corporate audit is over. I submit. I compare the stock in the stock statement given in the month of April and the stock figure, the inventory figure disclosed in the balance sheet, whether they are the same. If they are the same, there is no issue. If there is a difference of about 3 to 5% also, I might not take a very serious view of it. But if the discrepancy is more than 5 or 6%, more than 5%, say something like 10% or 15%, then I am concerned on the audit. And more than me, I think the branch manager should have been concerned about it. He should have looked at the financial statement and compared it to the stock statement given as of March and asked a question in writing to the borrower as why is there a discrepancy between the stock statement figure and the figure in the audit financial. If he had not done that, then what kind of monitoring is he doing? Are there not questions in our long-form audit report about where we have to comment about the monitoring done by the branch management? Then the entire monitoring fails if he has not done that. Even if he has done and there's no reply at all from the bank, it is okay, he has tried it. But finally, I think as auditor, we need to understand whether the stock figure as of 31st March signed only by the borrower should be taken as evidence, or the audit or inventory figure in the audit financial signed by the borrower and us as members of the Insurance Charter Board of India, should that be taken. I would always say you have to go only with the audited financials and not with the stock statement. And with the difference of more than 10%, I would request all of you to rework the drawing. And if creditors figure is not available, take the creditors figure from the balance sheet again. Why don't you reduce that? We compute this. I know. I think the immediate response will be, do we have the time? We have to find the time. I don't think we can walk away from an assignment saying lack of time. We have accepted the assignment. Time given to us is limited, and we knew that the time given to us is limited when we accepted it. Maybe we can always push the deadline by a day or two. So far in my 32 years or 33 years of doing bank audits, no bank has ever found fault with me for not submitting the audit report of the branches that is allotted to me within the time specified. I've always taken a day or two, and in some cases, some large branches, I've even taken 3 days extra than the deadline fixed. They have never found fault with me. The only thing I do is I try and contact the regional office or if necessary the head office even before the deadline is over and tell them, look, I have these problems, these are the issues, therefore I am going to take a day or two more. Please, let's not just blindly stick to the deadline and lack of time. Second point is inspection. If you ask them have they inspected, they will give you some inspection register, or they'll give you a paper which is normally filed, where you have nothing other than the name of the borrower, date of visit, and comments, unit working satisfactorily. Is that inspection? I think these are the things that RBI wants us to bring out of the long-form audit report. And as Sundar very rightly pointed out, it is because we have been answering questions in long-form audit report by yes, no, or not applicable. The entire scope of long-form audit report has been enhanced. I'm pretty happy that it has been enhanced. But I also would have liked it if RBI had said, do not insist on audit report until the 31st of April or the 30th of April. That would have given us a lot more time to do a damn good quality work. So please don't talk about time not being available. Please look at these things, and all that Sundar pointed out as far as the trying for to be computed properly is right. Only thing that I would again like to add there is difference between large advances and other advances. Every branch has a DP register. In spite of the fact that everything is computerized, they have a DP register. The minute the stock statement is received, it is entered in the DP register and the DP is found out. As you glance through the DP register, you will come across certain cases which may not be large advances, which are other advances, where the register has not been maintained properly. I think you should put on a suspicion. Those are cases which you can actually pick up and look at. What do we do? Do we look at the process of what Subhashini's question was? Yes, we have to look at other advances. Because of time constraint, we might look at 100% of large advances and do a sampling of small other advances. Maybe there are 1 or 2 cases in the DP register which might catch our eye, which might have to be included, or even if it is not there, look at it specifically from the point of DP and see whether things are. Thank you.
Thank you, sir. So next question is to Sundarajan, sir. This is a live question which has come now. Of course, like they are all talking on the revised LFAR and the extended audit, extended answers, extended care which we have to take. And there's also the other situation of COVID where we are not able to travel, where we have to do online mode of audit. So the question here is, how do we satisfy ourselves in terms of the cash documentation and signing of the balance sheet, etc. in offline mode? There's a question from CA Prabha Govindrajan.
See, as far as cash is concerned, let me be very, very clear. I have been talking on this subject for the 20-25 years. Verification of cash is absolutely not required as far as a branch audit is concerned. As on 31st of March or 4th of April, when you go for an audit, automatically everybody goes and verify the cash. Absolutely, it is not our area at all. But what we are supposed to verify as far as cash is concerned, whether the dual responsibility is there in respect of cash, that has to be verified as part of internal financial control reporting. That's all. But the problem is, people get carried away that once they go for a bank audit, they want to verify the cash transactions, which is of no relevance, first of all. So in that situation, verifying the cash for this particular day as on the date of audit is not at all required. So you are not bound to go and verify the cash at all. First item. Second item, as far as this monitor, that is cash scroll is etc., you can ask them to send the scanned copies etc. You can verify whether it is dual control is there or not. But you are supposed to verify very clear, report clearly in your report saying that due to pandemic, I was not able to report. You have to make a very, very clear disclaimer in the audit report saying that we have not physically verified the branches. Because of that, we have not been able to verify the following things in a detailed manner. As far as documentation is concerned, I'm not talking, knowing what the madam was talking about this documentation, whether it is documentation of loans or documentation otherwise. Let us talk about documentation on loans first. So in that situation, for each and every loan, there are documentation which has been prepared or signed or as the case may be. Normally, the documents nowadays, like State Bank of India, Canara Bank, etc., they are having it in RSCPC branch. That is, they are having in a centralized branch level. In fact, there is one classic question which has been included in the long form audit report. Wherever you are going and verifying the documents in respect of an RSCPC branch, whether the documents which has been listed by you has been satisfactorily given by the respective branch or not. If they are not satisfied, we are supposed to give a report. What happens is in the case of RSCPC branches, they don't send the documents outside the RSCPC at all. Yesterday, in fact, one of my colleague chartered ones asked me what should I do in respect of a branch at Kerala where I'm not able to travel at all. I gave them an option saying that even though you are not supposed to do a total outsourcing of a branch audit, it is ideal for inviting one of your colleague professionals in the other place to go and verify the documents according to your stipulations, your checklist, etc. Let them go and verify the documents and send you a report that I verified the following documents according to your requirement. On that basis, you can conclude the documentation has been verified. If that is not possible, then definitely you can ask for certain level of documentation from the respective branch. Probably the branch official can bring those documents to Chennai. If they are able to travel, you can verify the documents. If that is also not possible, the only way is disclaimer. That is, I'm not able to verify the documentation. Leave it and close it. That's all. Beyond that, we cannot do anything at all in view of the pandemic. In fact, last year, I will tell you the practical example of our office. Even though I have not done the audit in detail last year, what our team is, one audit was done in Annanagar branch, which was within the city. One audit was related to the Vellore branch. The branch, the partner in charge went to the Vellore branch for only 1.5 days, wherein they were able to verify all those documents and come back, and all other items they verified from the system in the state company Annanagar itself, which was possible to be done. So it is the respective branch auditors to find a way out of how to satisfy yourself. See, we can only make things which is available within the parameters. If it is not possible to be done beyond a level, we are very much under our own right to give the disclaimer. We are very much in our own right to say wherever we have not verified, we will have to say we have not verified. Wherever we have been able to verify, those items alone you can verify it. And if to that extent, you can definitely do subcontracting. Once again, subcontracting you will have to do to the respective experts on whose work you can definitely depend upon on the basis of the documentation support which you are going to get it from the person who is going to verify those documents there at the respective branch.
Thank you, sir. I think you've also answered one other question by Balaji Annu. They have put across a question where the loans are sanctioned by the Central Processing Center. Like, should I actually receive the documents? So there is a specific question in the LFAR. So satisfy yourself to receive the documents and to make sure you're ready. And the next question.
One linked answer in respect of RSCP is actually the branches will not move the documents out of RSCPC for security reasons. So they prefer the auditors to come and verify there only. In case of there is any problem at that some point of time because you having asked for the documents, obviously auditors will be held up responsible at a later date. So it's better we will go and verify where it is being stacked, where it has been listed out, and if it is not possible to verify, better you give it as a disclaimer and leave it.
So, Ramesh, can you throw some light on the case?
Yes, can I just supplement what Sundar said?
Yes, sir.
Sure. I only said that we don't use the word subcontracting.
Yeah.
For example,
okay.
with your idea, with your suggestion of asking a professional colleague in Kerala to verify it, I think we need to send him a mail or something requesting him to, on our behalf, go and verify that. And we as a branch here, we would do it because we give a declaration in our stating that we will not subcontract the work. So let's not use that. And that is also I understand you use the word in the normal sense. I didn't want that to create a thing, the minds of the members listening. And let's also in our thing say, due to the COVID pandemic, I'm requesting you to do it on our behalf and give us a complete report, and you are very right in pointing out that it should be done according to our checklist and not at his whims and
Not according to that case.
not according to him. The other one that I wanted to say is you spoke about dual responsibility. In fact, when we talk about, and it's a very, very important question in long form audit report, whenever we talk about dual responsibility, I think it's very necessary for us to look at the key movement register. Unfortunately, most of us don't even know that the key movement register exists in the bank. This would probably be known to people who did the audit about 30 years back when it was not computerized and everything was manual. Whenever the cashier goes on leave or the cash officer goes on leave, he hands over the key to somebody else as designated the manager, and this is recorded in what is called the key movement register. So if A has the key and he is going away on 3 days leave and he gives it to B, it is recorded and that is signed by both A and B. This is the only way that the bank tracks that who is responsible for the key at that point of time. This has been given a go by most branches today. When you go and tell the branch manager where is the key movement register, he himself doesn't know what it is. And then he has to call his oldest member of the branch and ask him, and they pull one out, which is not updated. That is something.
Either pull one out
I think there is something which the internal auditor needs to do, the concurrent auditor needs to do. But when we are talking about doing remote audit where we don't verify cash, we are looking at the scroll, I think we should also ask for this and then add it in a report if it is not maintained properly, because that is the key of dual responsibility. Otherwise, he will say, I never held the key, B will say, he never held it. One other point before I close out is, we were talking about stock statement. I've got to mention that in State Bank of India, the system is such that if the stock statement is not received for 3 months, the system automatically makes the DP 0. Well, that's a beautiful internal control. And I think that is something which we can check to see whether it does it in the other banks also that we are auditing. And if it is there, then to that extent, the internal control is far better. Otherwise, it gives a scope for the bank staff to receive the bank statement, the stock statement late, and then enter it as if it was received in the previous month itself. So, is the system taking care of it? Is something which we can look at from the point of view of internal control.
Perfect, sir.
Yep.
Yeah, Ramesh, can you throw some light on the KCC loans and the related IRAC norms?
What loans?
KCC, Kisan Credit.
Well, to be very honest with you, KCC is not something which is my area of things that deals with agriculture, but I'll tell you the basics of KCC. Kisan cash credit is nothing other than it is a cash credit extended to an agricultural borrower and not a normal borrower. That is the first essential difference in the KCC. The KCC account also has to be renewed on a yearly basis, and if it is not renewed within a period of 180 days from the date on which it expired, the account will become an NPA. The KCC, the classification of KCC will also follow the same IRAC norms of 2 crop seasons instead of 90 days. So as long as the it is out of order and continues for a period of 2 crop seasons in the case of short-term crop loans or 1 crop season in the case of long-term crop loans, it will become an NPA. Is there anything else that the question specifically?
No, in this KCC itself, Kisan credit loans, there is also a possibility that Kisan credit loans are given on not on an annual basis for a specific crop. That is also possible. So it depends on the respective banks' processes in the local regions and SLBC, etc. So there also the situation will happen. May not be a renewal on a regular basis or whatever it is. The point is we have to ascertain at that respective level what is the sanction. It is for a specific crop period. Once that is over, fresh loan is given, or it is a continuous renewal which is being given. Both depends on the respective cases.
Okay. Thank you, sir. So, can we just take some lighter questions on ATM verification? So, there are like a lot of questions around ATM verifications, like online ATM, offline ATMs. And when ATMs are located at different points in time, then how do we check the scroll balance and the cash balance at the bank and types like that? Sundarajan sir, can you throw some light on that?
Yeah, basically let us understand the difference between online ATM and offline ATM. Online ATM is an ATM attached to the branch which is located inside the branch itself or just outside the branch, so that it is updated online. Whenever a transaction, that is, whenever they go and load the amount, automatically the entry passes from branch cash to ATM cash. The other offline ATM is an ATM machine belonging to the branch or controlled by the branch, located at an outside location, probably in a nearest school or nearest office, as the case may be, because not that all the ATM machines are located in the branches only. ATMs are located in multiple places, so certain ATMs are allocated to certain branches. So those ATMs located outside the branch in a different location are called as offline ATMs, and what is located inside the branch or exactly outside the branch in the compound, it is called as an online ATM. But as far as this difference of ATM control entries are concerned, see, in respect of online ATM branches, obviously when a cash is being loaded into the ATM, immediately that entry will be triggered from branch cash, it will be reduced and it will be added to the branch ATM cash. As I already explained, that cash verification is not our forte and there is no compulsion for us. But at the same time, we are supposed to verify whenever they are doing an ATM loading. It is ideal for us to go and verify at that time. The reason is we will be able to have a control of verification how this ATM process is happening. In that situation, the ATM will have transactions done by various branches, various banks from this branch's ATM account, because now it is multi-banks, multi-branches. There is no compulsion that the same bank will operate here. So in that situation, the transaction will be done on a day-end activity that whenever, for example, I am auditing a branch of a Union Bank of India, some Canara Bank fellow, some Indian Bank fellow account holders will come and operate in this ATM account. At the day end, as far as my branch ATMs is concerned, it will be funds utilized by some other bank's operations account. It will be coming under an ATM suspense. That will reverse once I get a credit transaction from the other branch, maybe on the same day or on the next day. So the ATM suspend transaction will be pending only for one particular day. It should not be pending for beyond one day. So in that situation, what will happen is today's transactions of my own branch account holders, it will be transacted immediately. Whenever it is related to the other branch or other banks, it will not be done on the same day. It may be done on the next day maximum. So what as an auditors we are supposed to verify is whenever the ATM accounts are machineries are being refilled or examined at that point of time, please go and verify what is the balance as per the ATM account, as far as your branch ledgers are concerned. What is the cash available? What is the difference? The difference has to be correspondingly controlled by a slip of transactions which is available, cash drawing by various branches and various bank customers, which will have a list which will be reflected on the next day, which will be reversed on the next day. So there can be only one day's transaction which will be pending in respect of ATM. Next day it will be reversed. As far as branch auditors are concerned, our only responsibility is, in case it is possible at the time of when you are doing the audit, when the ATM is being refilled, go along with the refilling team, take that there will be a checklist which will be printed out from the ATM. What is the cash balance before filling up? What are the transactions which has happened from the last filling until this filling? That printout will be taken, and what is being loaded also will be printed. After loaded, what is the balance that you can bring it. Go and verify with your branch's ledger transactions, and on that basis, next day you can go also verify whether this has been reversed. With this, our responsibility will be over. Beyond that, our responsibility is not there.
Thank you, sir. So the next question, there's a specific question from CA Ravinder. I request Ramesh sir to throw light on the IRAC norms and the provisioning pertaining to this, and on the reporting part, I would like to write the response from Mr. Sundarajan. Here the question is, there's a tripartite agreement for a house allotted by the government, and there is absolutely no security. The houses are not hypothecated, and all the loans are around like 2 lakhs each. There are about 30 such accounts in the branch. So, and the outstanding, or probably like he's just mentioned this as outstanding. So if we presume that there are no credits for the last 5 years, he specifically said like the assets are outstanding for more than 5 years. So if we assume that there are no credits for the last 5 years, what would be the provisioning norms as per IRAC, and what would be the reporting in LFAR?
Ah. Is it? I only missed out the first part of the question, which is these loans are guaranteed by the government, is it?
Yes, sir. These are, yes, should be guaranteed by the government. The question is not very explicit, but I think it will be guaranteed by the government. It says that there is a tripartite agreement between the government, the bank, and the borrower.
Well, I'm assuming that these loans are guaranteed by the government.
Yes.
Again,
Because Pradhan Mantri Yojana, it should be guaranteed. That let's assume that way.
Right, and let's assume that it has been guaranteed by the central government.
Yes.
Because it comes under Pradhan Mantri and not Chief Minister, so it must be central government guarantee. Now the question is, for 5 years there has been no credit in the account, and what is the standard the bank has taken? Are they continue to classify it as standard? It's one thing that I would look at. The next is, what do the sanction letters say? Third, irrespective of what the sanction letter says, an account which does not have any credits at all for more than 5 years is something which ought to be classified as NPA by all norms. Even without IRAC norms, it should be classified as NPA. So with IRAC norms, it should be classified as NPA. But I think if it is guaranteed by the central government, then the bank should have invoked the bank guarantee by now. Why have they not invoked the bank guarantee is a question. Or have they invoked the bank guarantee and central government has not repudiated its claim? In other words, in spite of the bank invoking the bank guarantee, the central government has still not communicated to the bank that they will not pay. Here we need to look at IRAC norms for guidance. The prudential, the circular on prudential norm says, once an account is guaranteed to the state government and the bank invokes the bank guarantee, if the state government does not pay within a period of 90 days, the account will become an NPA. In other words, from the date of invocation, the bank waits for 90 days. If the money doesn't come to the state government, the account should be classified as NPA. In the case of central government, it says as long as the central government has not repudiated its claim, that is, it has not refused to pay, the account can continue to be classified as performing. Although I don't know whether 5 years is the time during which central government will not repudiate or communicate about it. I, as an auditor, would want a specific letter of representation, not from the branch manager, but from somebody at the head office, because they are the only ones who will know whether the central government has repudiated the claim. First of all, whether the bank guarantee has been invoked. If it has not been invoked, then it calls for a comment in the long form audit report. If it has been invoked, I want a certificate from them that till now the central government has not repudiated the claim. It will still call for a comment from the long form audit report. In the long form audit report, I would like to point out, if they have not invoked, I would like to question why they have not invoked. And my comment should say that in our opinion, that should have been invoked by now. Why has it not been invoked? Two, if it has been invoked and repudiated claim has not been repudiated, I would probably in my long form audit report say, what are the steps taken by the branch, by the management at the head office level to ensure to communicate with the central government and resolve the issue? And I would probably ask the central statutory auditors to look at this case a little more deeply at the central office level. And if there are several more cases like this in various other branches, then a collective decision needs to be taken. Is there any other part of the question that I missed out, Subhashini?
That's it. So from the IRAC norm perspective, obviously, like with the given facts, we can only say like this has to be either classified as losses or the claim has to be submitted. So probably like if Mr. Ravinder can bring out more light on the issue, or probably like he can contact you directly for more clarification so that he reports and does the.
We can come up with the right answer. Before we move on to the next question, I just looked at the guidance note of the Insurance Charter of India, paragraph 10.16, which deals with KCC, just to check whether what I said and to an extent what Sundar said, because I checked mine, whether Sundar said is also right or whether we had made a mistake there. I think the only mistake we made was in the expansion of KCC. It is called Kisan Credit Card and not Kisan Cash Credit. Otherwise, we were both right in whatever we said, and I would really request the members to read paragraph 10.16 on KCC. It's a very short paragraph, for 1.5 pages, the 2 paragraphs on it. That will throw more light on the KCC. Otherwise, whatever we said, we stand by whatever we said.
As far as the reporting is concerned, as far as the government guaranteed accounts, as you have asked
Yes,
me
sir.
to respond to that.
Yes, on the
Well,
LFR part.
obviously, this would have been a large advance because once it is a central government guaranteed accounts, it's a larger project or something like that. Definitely, if it is a smaller project, it may be coming under other advances. I'm not talking about Prime Minister Rozgar Yojana. I'm talking about Prime Minister guaranteed account, some large account, the tripartite agreement. When you say it's a tripartite agreement, that will be coming only in respect of, for example, road projects, a highways project like that, it will come. In those situations also, so we will be covering that area under large advance. So once it is large advance, once again, monitoring would have been a part of the reporting. Obviously, 5 years is not a small period for which the money has not come. So what is that they have been doing over a period of monitoring, and on that basis, what will be the correspondence which has been done? Like Ramesh correctly said, I wish to have a MRL from a higher ups, because definitely repudiation is done or not will be coming only at the highest level, not at the branch level, because branch level don't even know what is repudiation. That is the reality actually. So in that situation, we have to be more careful when we are going to give a report in respect of these advances, which is guaranteed by government.
Yes, sir. So I would like to continue with Sundarajan, sir. There's a live question from CA Kishore Kumar. With reference to the stock statement not collected by the branch, do we need to insist branch to collect penal charges? I would like to add something here. What happens to the moratorium period? So if obviously, like all the branches are going to bring in a defense point to say that RBI has given a holiday, is that holiday pertaining to only the interest principal, or even these kind of documentation of submission of stock statements? Because practically it wasn't possible. What stand should we take while reporting in the LFAR for this particular holiday period, and of course the other ones?
See, it's basically a systemic problem. Levying the penal interest or non-penal interest. Invariably, the penal interest is not being levied. If you examine any branches for that matter, at least for 2-3 months, they don't levy the penal interest. Basically, they are going to charge 12.5% interest rate. Whenever a stock statement is not being collected, it should be 13.5%. Automatically, the system has to happen. If the system has not been included in that, obviously, we will have to examine whether the revenue recognition is, revenue leakage is there in respect of these items. That is a separate ballgame altogether. But as a branch statutory auditor, to the extent of what are the advances you verify, please ensure whether the penal interest is being collected or not. It is not that you can instruct them to collect the penal interest or not. Whether you instruct or not, they will not collect. Even you instruct, they will not collect. So let us not go to the level of instruction. As far as we as branch statutory auditors are concerned, let us just restrict ourselves to examine whether the penal interest has been collected. If it is not collected, we will only say the system of collecting the penal interest is not in prevalence as far as this branch is concerned. Number one, if you are able to quantify, quantify. If you are able to ensure that it is being collected, you can also give an MOC. That's all we can do. But as far as this, you are raising a question on what is the other question apart from
during the moratorium period, we have
moratorium period. See, there was no correct. There was no moratorium given for not collecting the stock statement. There was no clear written moratorium given for not obtaining the stock statement, etc. But what happens is, in case of the COVID period, March, April, and May, many units have not been operating at all. So it is humanly impossible to give a stock statement in respect of these 3 months, and banks were also not functioning at fullest strength at that point of time. So in that situation, I make it a point that you may not be insisting for providing this penal interest, etc. We can leave it as it is. Just my personal opinion. But at the same time, if the same system continues, even after that they are not collecting this stock statement, we will necessarily report in the monitoring area as far as LFR is concerned. And also we say that penal interest shall be charged unless and otherwise the higher ups give a waiver by a written sanction that in respect of this group of advances, we will not levy penal charges for some time. The reason is, wherever they have charged interest on interest, they have been asked to refund. Wherever they have charged interest on interest, they have been asked to refund. But similar thing has not happened in respect of penal interest. So we can keep our fingers crossed unless otherwise branch is able to give an internal circular in respect of these particular banks, where they said that penal interest will not be levied for this particular period. Definitely, there should have been a possibility. I am not sure. Probably if any central charge auditors are there, they may be able to give us an input on that. In case I get a clarification, I will share it with the institute, which can be circulated to the members.
Thank you, sir. That was pretty clear. There's one other question from Shri Anand Balaguru, sorry. So FITL not paid till 31/3/21. So this is a general doubt where the moratorium period, there was a holiday period which was given, and of course, like the borrowers were given options to pay it later, post 31st August, and it has to be paid before 31st March 2021. But if this particular interest during the moratorium period is converted into an FITL, should that FITL be necessarily closed before 31st March 2021? I think this is one doubt which many people had. Can you throw some light on that?
The point is, yeah, please.
Go ahead.
The point is, as far as this moratorium of interest is concerned, this is applicable in respect of CC accounts or working capital accounts. Any interest, because term loans, they have given a specific moratorium of the 6 months, nothing will be paid, it will be postponed or whatever it is. But as far as CC accounts is concerned, from first March till 31st of August, interest will not be debited to that account, or whatever be the interest which is being debited to that account is recoverable on 1st of August 2020. This was 1st of September 2020. This was the stipulation. In case the borrowers are expressing an difficulty that I'm not able to make the payment, they were given an option to convert this period of 6 months period interest into an FITL, and FITL has to be settled by an installment which is determined in correspondence between the parties, borrower and lender, over a period of 6 months. That is, it need not be paid on 1st of September. It can be paid over a period of time. For a moment, let us understand that this FITL was not there. In that situation, 1st of September, it should have been recovered. So if it has not been recovered, 1st of October, 1st of November, 1st of December, this account will automatically become an NPA. Now, they have given an option because of this pandemic situation that can be converted into an FITL. So they have come to an understanding that it is being converted into an FITL, and the FITL is going to be paid starting from 1st of October, November, December, January, February, March, 6 installments. It is being paid. In that situation, once again, October, November, December, if these 3 installments are not paid, it will become an NPA. The other option is the FITL is not structured in this manner. FITL, it has been brought into the interest is accumulated and brought into an FITL, and say that FITL shall be paid on or before 31st of March 2021. In that situation, if it is not paid on 31st of March 2021, which is being you are audited also, it will not become an NPA, because it will become an NPA only on 30th of June 2021, because the due date is 31st of March 2021. After 90 days only, it will become an NPA. But this will attract a report in the long form audit report, because the sanction was given for a specific instruction that this has to be paid before this date, which has not been paid, which has to be considered in the form of a report in the LFAR. Ramesh, you wanted to add something?
Just to add to the last point that you said, when the sanction letter does not fix a time schedule, but says it should be closed out before 31st of March 2021, and if that has not been paid, it will definitely not become an NPA, provided that the interest debited in the month of October, November, and December has been paid. It will become an NPA even at the 31st of March.
Yeah.
Because there is no clear direction. As if it is not paid by 31st, then the entire scheme fails. Has not been clearly stated in the circular, and I think we need to give the benefit to the borrowers. Second, I think the logic with which Sundar has stated and the logic with which I agree is what has been stated in the master circular on IRAC norms. It says any amount due to the bank will become an NPA if it is not paid within a period of 180 days from the date of 90 days from the date on which it comes. So we go with the same thing. If they have been given time till 30th of March to clear out the FITL in a bullet payment, and then we have to wait for 90 days before it becomes an NPA.
Okay, so just to extend Sundarajan sir's example, so he said like if the first installment of the FITL is due on 1st September and it becomes due, and if nothing is paid, then it becomes an NPA. So
because
and generally like NPA is borrower wise and not loan wise. So will this tantamount to classification of all the borrowings pertaining to that particular borrowers?
I'm afraid so.
Why you are afraid? No. It has to be.
No, sir, I'm just asking. So both of you together answered. So I'm just.
No, it has to be. It's a borrower wise only. Once this account becomes an NPA, obviously other accounts which is maintained by him also will become an NPA. See, basically, let us understand one thing. The account has become sick already. Only because of this COVID extension or COVID restructuring, they have escaped. But now the escape cannot once again happen, one more escape. So because of this restructured methodology, not only this restructuring for that matter, any restructuring for that matter, once there is a restructuring, and if they are not able to stand to the restructuring methodology, obviously after the 3 months of period, it will become an NPA. Once this account becomes an NPA, every other account also will become an NPA.
Okay, sir. So there is one other question from the audience. One CAK Ranganathan. He has requested to throw some light on the Supreme Court judgment. So I would like to take insights from both of you. First from Ramesh sir, then from Sundarajan sir.
The Supreme Court interim order said that no account which has not been classified as NPA on 31st of August will be classified as NPA. That created a lot of confusion. In fact, I think the Indian Banks Association solved the confusion at the bank level by saying we will not mark it as an NPA, but we'll continue to provide for it and make adequate provision as per the IRAC norms. So to that extent, if you look at the reviewed quarterly financials of banks for the quarter ended December, there are 2 paragraphs in the notes on account which says we have not marked it as NPA because of Supreme Court interim order, but and the amount, the number of accounts which have not been marked as NPA is so much, the balance outstanding is so much, and we have adequate provision for it. In other words, they have followed the IRAC norms. They have not physically marked it as NPA, is what the banks did. Now, on 23rd March, when the Supreme Court came out with the final judgment and said it stands vacated, the confusion is removed. You go back to complete IRAC norms. The only thing is, you don't take the period from 1st of March 2020 to 31st of August 2020 for counting your delinquency days. If an account on 29th of February was overdue for 50 days, then from 1st of September, if it does not, if the overdue is not cleared within a period of 40 days, then on that day it will become an NPA. So if the account had no overdues at all on February 28th or 29th, then the account will go back to the normal days of 90 days starting from 1st September. In other words, the period between 1st March 2020 and 31st August 2020 is not counted for any purpose, for the purpose of calculation of NPA days. But that doesn't mean that the NPA, for the purpose of calculating NPA days, the day starts from 1st of September. 1st of September, it starts at the date on which the number of days are already accumulated till February. For example, if the month of December installment not been paid in a term loan account, then 2 month installments are already due. January and February is already due. Well, from 1st of March till August, nothing needs to have been paid, and therefore they are not paid. September was also not paid. Then in October, obviously 3 months installment is due. They should have cleared the January and February. They were given an extension only for March, which should be paid in September. But they have not paid January, February, and also they have not paid the September due, which is no longer March due, but September due. Then obviously the account will become an account NPA on October. Otherwise, I don't think the Supreme Court judgment has any changed the situation. In fact, has clarified the situation entirely. We need to go back to our original IRAC norms without counting the days 1st of March 2020 and 30th August 2020 for delinquency days calculation. Sundar, would you like to add something to that, Sundar?
Nothing except that. The only thing is, whatever be the circular which has been given on 6th of August 2020 has to be applied literally in respect of this restructuring moratorium period, etc. Otherwise, the entire provisioning norms as per our IRAC norms in the earlier cases will continue to apply. Number one. Second important item is wherever they have already done, that is, all the banks have already done the NPA classification, but they have only not classified those NPAs. In the month of September and December quarter, they have calculated what are all the items which has been slipped to an NPA, but not classified NPA according to the Supreme Court judgment. So, in that situation, for March, automatically it would have, that is, they would have just removed that particular button and all these accounts would have come as an NPA. Only thing is, there is a possibility that there might be some returns which has been already introduced by the respective banks for us to certify that what all the accounts which would have been become as an NPA or whatever it is because of this and has not been reclassified, or there is a possibility. I'm not sure. I have to check up with our bank audit where it has been commenced. In that situation, we have to ensure that all the accounts are coming into that particular returns, which has to be certified by us. Number one. Second issue, once there is a moratorium which has been given in respect of term loans, etc., we will have to ensure that all those moratoriums which is coming that March to August, whether it has been properly implemented, if it is implemented, whether it has been reported correctly, and in respect of that particular item where the money is not recovered, which should have been recovered from September onwards, if it has not been recovered, those places we have to be more But simple point is, as Ramesh rightly said in the earlier occasions, see for SMA 1 and 2 of January. See ask for the reports of SMA 1 and 2 of January 2021. And if those accounts are not slipping into NPA in respect of March, definitely there is something serious which would have been added or modified or triggered, or as the case may be, because LFAR also asks one particular item, whether the classification of doubtful and bad, that is performing and non-performing assets, has been done by the system properly without manual intervention. We are supposed to give a report. Auditors are supposed to give a report whether the classification of advances between performing and non-performing has been done in accordance with the system without manual intervention. So in that situation, we are necessarily go to verify whether any manual intervention has been triggered for identifying these NPA accounts. And apart from that, we are also supposed to verify whether the standard advances has been classified correctly between SMA 0, 1 and 2. That also we are supposed to report in the long form audit report. So previously we were supposed to verify only whether an account has been classified as substandard and standard and substandard. Now within standard, we are supposed to verify whether it is SMA 0, 1. I don't know whether it is a Supreme Court order is having an impact here or not, but I am saying that once the Supreme Court order, the revised order of 23rd March is there, all the other earlier occasions, whatever be the situation, will come into the picture. So the same 90 days norms, same 180 day norms in case of renewals, etc., except those accounts which got the benefit of restructuring because of this COVID or reschedulement because of this restructuring mechanism. These two items, we are getting the benefit. Other than that, all the other accounts, particularly these education loans which has not been restructured at the earlier occasions, or agricultural loans which has not been restructured because of this COVID, etc., those cases we are supposed to verify and report. Those accounts has to become an NPA, which has to be reported by us.
Thank you, sir.
1 second.
Yes.
Just one thing. So I think the
Yes.
question on long-form audit report that Sundar was referring to, whether there was any manual intervention in identifying NPA, I would request all the members to be very, very careful when they answer this question. Because if I remember right and my memory serves me right, I did come across a circular issued by Reserve Bank of India giving banks some more time, not 21st March 2020, beyond that, to get their systems in order, their implement technology in order to ensure, I think it is March 22.
You're referring to the September circular that is still June 21st.
That you have time to do it. I'm sure the banks would not have done it. So to that extent, I think you need to be very, very careful when you answer. Don't just say there is no manual intervention. Say we have not done a systems audit. We are, to the extent that we saw there are no, some sort of a disclaimer. At the same time, an answer is what you should actually draft and do it. If you say there is no manual intervention, RBI will say there is manual intervention. We know that's happening. How do you say that is not there? So let's be very careful with me. And regarding the penal interest, I personally think that they would have charged it this year. Whatever penal interest they missed out, they would have charged because of the compounding interest that they have to reverse. Because I have also seen from a couple of questions that my other clients have asked, that banks have suddenly started in the last week of March. They have suddenly debited several bank charges under the guise that RBI has asked them to do that. And if you look at what actually happened, when I looked at it, I found that RBI said something about that particular point, unhedged foreign exchange exposure. The circular is dated as old as 2014. It has reference to capital adequacy. They did not say you must charge extra interest from the bank. They only said, please build it into the product if you need to do that, the risk. And not having done it, they're suddenly coming and charging all that, which they did not do for 6 years. They suddenly on the 7th year, they're doing it just to prop up their profit figures. Therefore, the penal interest also may have been considered. please do look at it before you make a comment that it has not been charged, because there could have been a consolidated figure appearing sometime in March that has hit the borrower's account. So just be careful before you make the comment. I fully agree with Sundar saying that they would not have done it. Most often it is not done. Except in the case of SBI, I think it is done because the system automatically debits the penal charges when stock statements are not received. And in my experience of doing State Bank of India, the manual intervention is very, very low in State Bank of India. Therefore, to that extent, you can probably rely on their system much better than the other bank system.
In the Supreme Court order, one particular point which has to be mentioned is Supreme Court order made it very, very categorical. There will not be interest on interest which will be levied. There will not be any penal interest which will be levied. They have mentioned. But whether the penal interest which we are talking about now for non-payment of the installments or stock statements is not clear. Obviously, they have made it very clear that there should not be any penal interest levied because of the last 6 months hangout because of the Supreme Court earlier order. That is, just because of this September 2020 order, they have stopped from paying, etc. So obviously, when the payment is not made, there is a penal interest which will be leviable. That penal interest only they would have mentioned that there should not be any levy of penal interest. But obviously, I'm sure that because of the stock also, they would not have levied the penal interest. We will have to wait for the respective banks to respond to that.
Yes, sir. So there's one question from Radhakrishna, CA Radhakrishna, and probably like I would like to take the answer from CA Ramesh, sir. Interest during moratorium, if not debited to P&L, will it be an item of MOC? Probably like any of you all can answer that way. I think this is I'll leave it over.
The moratorium period is not debited to P&L.
Yeah. Interest exactly. Period should not be debited. I think it's the other way. No, if it is debited.
Which should be debited?
Interest on loans or interest on deposits? Because if it is interest on loan, it gets credited to the P&L account. And it would have got credited to P&L account. There's no doubts about it. The question is, interest on interest will also have got credited to P&L account. That should have been reversed. If that is not reversed, then obviously you would have to quantify it and pass an MOC. But I am sure because the judgment came out on 23rd March, they had enough time. They had almost 8-9 days, and they would have done that. But if you find that there is no reversal of compound interest during the last week of March, then you need to get the figures and pass an MOC. Unless there is a specific instruction from head office that this will be taken care of at head office level, then you need to draw reference to it in the audit report. Just like we do for a provision of bonus, provision for gratuity and all that, we do the same thing and say, you don't have to pass it.
Radhakrishna sir, hope your question is answered. If you would like to clarify more, probably like you can elaborate your question and put it more clearly so that they can take up the question. And there's one question from C. Ravi Shankar Radhakrishnan. If an account is classified as an NPA after the vacation of Supreme Court decision, will the date of NPA be 23rd March or the date on which the overdues has crossed 90 days?
It goes back to the original.
Yes, sir.
If we get the answer, I think both of us spoke at the same time and the answer did not come through.
Exactly.
The date will not be 23rd March because on 1st of March it will start. So it will only the delinquency date as of February to be counted. If it is 46 days on February 28, 29, then on 1st September it becomes 47 days. Therefore, that period will not be counted. In other words, you cannot have an NPA date between 1st of March 2020 and 30th of August 2020. This year you cannot have it. Otherwise, every day in the year there could be an NPA. Although most banks will normally keep it as a quarter ending or a half year ending or a year ending. The NPA should happen on a day and not at the end of every quarter. But this particular year, you will not have any account falling in made an NPA between 1st March 2020 and 30th August 2020.
For all practical purposes, the 6 months is not available in the calendar.
Absolutely.
For the purpose of this banking requirement, March to August is not available. The calendar is not available.
So technically, the financial year comprises only of 6 months.
Not 6 months.
Didn't touch the interest on deposits. Otherwise, I would have gone into a shock.
The other way around, yeah. So cost is there, revenue is not there. There's one question which came up earlier. So if the banks have opted out of the DIGC scheme, and they do not have the claim list of what came in and what is foregone. So the question is, what has to be reported in the LFAR pertaining to this? I think Sundarajan sir can take up this question.
The current year LFAR does not talk anything about DICGC. Current year LFAR, they have removed the DICGC from the report itself. So obviously, it has been set practice now that most of the banks have gone out of DICGC. So you might not be required to give any report on the DICGC component at all. We are supposed to, they are asking only for ECGC. They are not asking about DICGC in the current year LFAR. So you don't have to bother about that. Previously, we have been giving a nil certificate invariably in respect of the earlier DICGC cases. We don't have to give any certificate at all this time.
Okay, Ramesh sir, would you like to add anything on the provisioning norms? Because we would have considered this claim while making provisions during the earlier years. So is there something that we have to look up this year pertaining to this?
The provisioning norms remain more or less the same. The only question, the only thing that I would like to add there is, if the NPA date during the course of audit is determined to be a date which falls before 31st of March 2020, that should be taken as the NPA date, which means the substantive. So, for example, if it had become NPA as of December 2019, whereas the branch has made it as of sometime in April 2020 or September 2020, April 2020, you can't make it NPA. Then they would classify it as a substandard and make a provision of 15%. But if in your check you find that it is the NPA date should be December 2019, then it becomes, it's no longer substandard, it becomes doubtful. That is something which we certainly need to see. One. Two, I think you need to, when you're looking at the provision, you also need to look at the security. If there is an erosion of the value of security by more than 50%, then the account cannot be substandard. Even if the date says it's substandard, it should be classified as doubtful. And if the erosion value of security is more than 90%, the account should be classified as loss. This is something which we need to look at by looking at the value of security in the advances sheet. They give us what are the value of security they've entered. Is that the right value? Even if if they're let us say they're valuing stock as per the stock statement, and we have found in that account, we have verified that account and found that the stock figure in the financials and the stock statement differs huge variation. And I don't think we can go by that stock figure. So we need to look at that. Apart from that, I don't think there's anything additional provision that you need to worry about. The additional provisioning in case of those accounts which come under the COVID package where they're talking about a 10% provisioning to 5% provisioning to be made, an extra provisioning, which the bank will automatically take care of. That is something we don't have to worry too much about that. But you need to be clear about the NPA date. Invariably, I have found that when I look at the NPA statement, the date of NPA as per the last audited statement and this statement, there is a change. Just to keep it, in substandard or in D1 itself and not to go to D2. I would not verify this year's or current year's NPA statement without having a copy of the last year audited NPA statement. The first thing that I look for is there are 24 accounts in the last year's statement. Are the same 24 accounts available in this year's statement also? If they are not available, my question will be, why are they not available? Have they been written off? Have they been closed out by an OTS scheme? What exactly has it happened? Or in a very rare case, has it been upgraded? If it has been upgraded, then I would also like to look at that account. In fact, me and Sundar were discussing sometime in the afternoon as to the percentage of verification we do. We both agreed that we have to necessarily verify 100% of all large advances. We have to verify 100% of all NPA accounts. We have to verify 100% of all restructured accounts and 100% of all upgraded accounts. Because unless we do that, we cannot be sure whether things have been worked out correctly, whether the upgradation has been done correctly, whether restructuring has been done correctly. Apart from this, I don't think there's any major issue as far as provisioning is concerned. Yes, there are concerns with regard to project loans and things like that, where by postponement of a period of the TCC completion date, there could be extra provisioning required. I don't think that is of any relevance to to people like us who are doing small and medium-sized branches, not really large branches, because those are the branches where we will have these kind of things. Is there anything else on provisioning, Sundar?
All right, that's clear, sir.
So there
are 2 more questions.
I mean, if the question wants me to throw light on the rates, I can tell them the rate, but rates of the same.
I think that is available everywhere. So there are two other questions. Probably like we'll take these two questions for the day, and we'll continue tomorrow. One question is from Anand Balaguru. Please throw some light on generating and verifying exception reports. Whether hard copy of the printouts of exception reports are to be insisted by the auditors. How to report under LFAR. And there were other questions also in terms of receiving the soft copies from the banks, where the banks are resisting to say that like we don't have instructions from the head office to give you soft copies. So Sundarajan sir, can you cover both these points?
I will answer the second question first. No bank is authorized to say that I will not give soft copy of the report. It is absolutely not possible, because we are verifying only on the basis of information which is provided by the branch, and no bank can say that head office has instructed not to give, which is not possible. In fact, I had an opportunity to talk to two SES, Certified Central Auditors. I asked them, two different banks, is there any restriction or reservation which has been given for not giving an access to the system or not giving the report, etc. They made it very, very clear. Ask the respective branch auditors to go to the respective regional office to ask for the permission, and in case it is not possible, ask them to get in touch with the circle auditor to whom they are reporting to. I will be able to give that input, including the access control. So to that extent, it is very, very clear. So let us be very, very honest and upright in understanding that all the banks are supposed to give all the documents which is required by you. In fact, if the report certificates, consent reports are not given, you can very well give it in your report that the reports are not given. This is first item.
Therefore,
Pardon?
Therefore, you able to come to a conclusion about the true and fair view of the balance sheet.
Obviously, we are not able to give a true and fair view in view of the absence of the necessary statements. But as I told you in the first stage, large advance, we are supposed to verify the transaction audit. How do you verify the transaction audit without getting the ledger copy of the particular borrower? Absolutely not possible. And coming to the exception report generation, I would like to repeat, because I am not a very tech savvy person, but let me be very, very clear that audit module of the respective software, let it be bank software or let it be financial software, both the software, when you go into the audit module, you are automatically led to a exception reports. Once you go to the exception report, soft copy can be downloaded, and the exception reports gives plethora of reports. And only thing is, we should know which report we have to utilize. That is important. So on that basis, you can take to a conclusive situation. Out reports has to be mentioned. LFAR also requires reporting on this area. More than LFAR, we are bound to report whether any provisioning itself is required in respect of exception reports, particularly in respect of debtors, I mean sundries and suspenses, which are coming in the long form the exception reports. From that, you will be able to determine what are the items just be reversed itself by way of an MOC. So, audit module of the respective financial and bank software, both software has the audit module. Go to the audit table, ask for the expression reports, it will automatically generate. From that, you can download into the Excel format and take it into your soft copy. Most of the banks don't allow pen drive to be utilized in their software. Download it in the respective computer hard copy, ask them to mail it to you. They'll be able to mail it to you. From that mail, you can access, you can modify, you can restructure, you can do whatever it is required in respect of an Excel updation and utilize that format.
Thank you, sir. So the next question from the last question for the day from CA Balaji Anu. There are two questions actually from him. I would like to take both. The first question probably like Ramesh sir can throw light on. His question is on appropriation. He says like there's a housing loan which is classified as fraud, and there is some amount which is received from them. So do we appropriate this as interest or principal? Which comes first is his question. To read out his question verbatim, amount received from customer related to fraud housing loan considered as interest income first or need to adjust against principal amount?
Before I go into that question, I would also like to supplement what Sundar said about exception reports. Exception reports are generated with the software on a daily basis, which the branch manager is expected to verify and sign off. Some exception reports are generated on a daily basis, some on a quarterly basis, half-yearly basis, and daily basis. As an auditor, I would probably want to look at the exception reports generated by the system without even going into the audit module. By the normal system, on the last day of every quarter, and also on probably the 28, 29, 30, and 31st of March. I am able to look at that, and there are two or three things that comes out of it. One, it gives me a great opportunity to look at areas which have come out of the acceptance. Two, it gives me an idea of whether the manager is actually doing his job of verifying the acceptance reports on a daily basis and doing his job. Otherwise, he's not doing his job properly, which needs a comment in the long form audit. You can do. Coming to the question that has been addressed to me in a fraud. Normally, in a fraud account, we don't do any appropriate. In an NPA account, money recovered is appropriate towards the account. In a fraud account, the amount till the case is settled or something, it is not done. The amount collected was also kept in a suspense account in the liability side. In the asset side, we have the loan account, which is classified as an NPA, for which 100% provisioning is held, and it is kept there in the advance side. On the liability side, we have, say, amount collected, saying that it is kept. It is not appropriate. Two, the general rule of appropriation is first the penal interest, then arrears of interest, then current interest, and then only principal. Unless there is an agreement between the borrower and the bank of a different appropriation, this is the rule that will hold good, is what RBI said. And to my knowledge, no borrower has an appropriation rule that different than this, because they don't sign a different appropriation agreement with the bank. Therefore, this will hold good. Penal interest, arrears of interest, current year interest, and then only. So if it has been recovered, it cannot go to anything. It cannot go to the principal amount. It has to only go to the arrears.
Perfect.
But it is normally in a fraud account, to my knowledge, it is not appropriate. It is kept separately and then answered.
Thank you, sir. And the last question is, he says the stock statement is not updated on 31/3/2021. And just because of the stock statements are not updated, I just assume that there are no stock statements received for quite some time, and the account becomes NPA as on 31/3/2021 because of non-receipt of stock statements. Now the stock statements are made available. Whether the classification is required, whether the MOC is required or not.
31/3/2021 stock statement is not available. And because of that, account becomes an NPA.
His question just says that just because of not updated stock statement on 31/3/21, one account becomes loss account. I think he means NPA. Now stock statement is available, whether MOC is required or not. Probably we can take this question as a general point where there are no stock statements available for consecutive 3 months earlier. Because of which
I presume that the account has already become an NPA. I think I assume that the account has already become an NPA, and they do not know the value of stock, and therefore the value of stock has been taken as 0 in the absence of a stock statement, and they have now got a stock statement. That is the question. I would probably say if you have not got a stock statement for so many years together from the time it became NPA or during the whole year, and you suddenly get a stock statement of 2nd or 3rd of April or 4th of April, talking about 31st March stock statement, I would not pay much credence to it unless it is certified.
So if we are going to assume that we have not received the stock statements from January, if that be the case.
From January, if it has not been received, then why is it an NPA first? Is it NPA because of a completely different reason? Is it a standard account for which we have not received, or is it an NPA account? That's the question that I would like to ask.
It will slip into NPA because the stock statement is on 31st March. So it could be like December, January types.
Right. So if you use the word slip into NPA, he's talking about an account which is a standard account. In December, the stock statement has been received. So, in my opinion, the account cannot become an NPA on 31st March. It can become an NPA only on 30th June, because a DP can be fixed based on a December stock statement, December 2020 stock statement. A DP can be fixed for the month of January, February, and March. So, the DP is there, and if it is operating within that level, within that DP limit, I don't think the account will be classified as a.
Adding one more assumption to this.
If the branch is classified as a non-performing asset, then there may be some other reason, not just the reason of non-submission of funds.
Just extending the assumption that he has not received the stock statement from August. Then what?
Then the account becomes an NPA. And if there is no other proof of this thing, what they did of showing it as a loss asset because of the no stock statement, it would be a very valid one. And if they give a stock statement on 5th of April or 6th of April, I probably would view it with a lot of suspicion as an auditor. For 7 months or 8 months or 9 months, they don't submit a stock statement, and because we have classified as losses, they suddenly come and give a stock statement. Unless it is also attested by the auditor of that unit, I might not pay much credence to it. I would not want to go ahead and pass an MOC lifting it from loss to substantive. Transitory was classified as loss. Why will I upgrade it without proper evidence? I would take the safe stand, maybe make a comment about it in my long-form audit report and leave it at that. I will certainly not propose an MOC. If the reverse, I would do that, but not upgradation from a loss asset to a substandard asset without proper evidence. It's just a piece of paper signed by the borrower. Why should I pay credence? I will pay credence to it if it has been submitted on a monthly basis following the system. When they deviated from the system, then I view it with a little bit of suspicion. And non-submitting of stock statements on a regular basis is one of the EW RBI circular out of the 45 cases. That is one of the early warning signals. So in fact, it should have been brought to the attention of the branch management should have taken the signal even in the month of August or September when the stock statement did not come. And therefore, I don't think we should upgrade it by passing.
Thank you, sir. I think we should take up the balance questions tomorrow. Over to the organizers.
Thank you, sir. Thank you so much, madam. Panelist, sir, please unmute, sir. Unmute.
I unmuted, sir.
Yeah.
Can I conclude or you want to
Still,
speak?
we are having a lot of stock of questions.
Yeah.
Maybe we will continue tomorrow the same time. Maybe exactly 5 o'clock we will meet. We'll try to
We have to
complete
only
entire
confirm that we only have to confirm that the stock has a value.
That's a good one.
It is obsolete stock, yeah?
So we'll call it a day for the event. With the permission of chairman, I'll conclude by proposing vote of thanks.
Yes, sir.
Am I permitted, chairman, sir?
Yes, sir. Yes, sir. Please.
Right. So it was a very, very exhaustive and what's called mouth filling, what's called stomach filling, everything for the members today, because even minutest of the questions are answered. Despite best efforts by Subhashini madam, I think there are still a stock of questions.
Yeah.
You could not complete all the queries as requested by the chairman. So hats off to your efforts, sir, Ramesh sir and Sundarajan sir. I hope tomorrow we'll continue the session with the today's talk and fresh talk for tomorrow. In these words, your sacrifice is definitely recognized very heartily by SIRC. Your efforts are always great blessings to the SIRC. Thank you very much, all the three of you. Thank you, Chairman. Thank you, Chairman.
Thank you.
Thank you.
Thank you, sir. Thank you.
First time we are allotting so much of time for question and answer sessions, which is very, very vital. See, monotonous presentation on one side may not be enough for one surprise, but definitely the question hour will definitely make many understand. Most of the people, members would not have raised that query only when they come to know that the particular question is raised here, they get the clarifications. And this is an excellent job for which I compliment and thank our chairman and also for the support, the back office of the SIRC and our technical giant, Mr. Selva, for the technical support, uninterrupted technical support. Thank you, one and all, for the day's
Thank you.
Thank you, sir.
Thank you, sir. Thank you, sir. Good night, sir. Good night.
Thank you.